Today, we will talk about the fractal indicator, what is it and how to trade. The fractal indicator is based on a simple price pattern that is frequently seen in financial markets. Outside of trading, a fractal is a recurring geometric pattern that is repeated on all time frames. From this concept, the fractal indicator was devised. The indicator isolates potential turning points on a price chart. It then draws arrows to indicate the existence of a pattern. The bullish fractal pattern signals the price could move higher. A bearish fractal signals the price could move lower. Bullish fractals are marked by a down arrow, and bearish fractals are marked by an up arrow. The fractal indicator will generate signals frequently. The existence of a fractal isn't necessarily important since the pattern is so common. The fractal is indicating the possibility of a trend change. This is because fractals are essentially showing a U-shape in price. A bearish fractal has the price moving upward and then downward, forming an upside-down U. A bullish fractal occurs when the price is moving down but then starts to move up, forming a U. Because fractals occur so frequently, and many of the signals aren't reliable entry points, fractals are typically filtered using some other form of technical analysis. Bill Williams also invented the alligator indicator, which isolates trends. By combining fractals with trend analysis, a trader may decide to only trade bullish fractal signals while the price trend is up. If the trend is down, they may take only short trades on bearish fractal signals, for example. Fractals could also be used with other indicators, such as pivot points or Fibonacci retracement levels. A fractal is only acted on if it aligns with one of these other indicators and potentially the longer-term price direction. Fractals are not typically used as an entry signal alone. The fractal indicator is unique in that it identifies a price pattern and marks it on the chart. Fractals are specific 5-bar patterns. Chart patterns can also be drawn on the chart, although they are not limited to 5 price bars. Popular chart patterns include wedges, flags, and head and shoulders, to list a few. While some software will mark chart patterns on a chart, most chartists find and isolate chart patterns by hand. The main problem with fractals is that there are so many of them. They occur frequently, and trying to trade all of them will rapidly deplete a trading account due to losing trades. These are called false signals or whipsaws. Therefore, filter the signals with some other indicator or form of analysis. The arrows for the indicator are typically drawn over the high or low point, which is the middle of the fractal, not where the fractal completes. Therefore, the arrows can be visually deceiving. Since the pattern is actually completing 2 bars to the right of the arrow, the first available entry point after seeing an arrow is the opening price of the 3rd bar to the right of the arrow. Here are 5 key takeaways. 1. A bullish fractal occurs when there is a low point with 2 higher low bars/candles on each side of it. 2. A bearish fractal occurs when there is a high point with 2 lower high bars/candles on each side of it. 3. An up arrow marks the location of a bearish fractal, while a down arrow marks the location of a bullish fractal. 4. Arrows are drawn above or below the middle bar, high or low point, even though the pattern is 5 bars. 5. If someone were to trade fractal signals, the entry would be the open price of the 3rd bar after the arrow. Hope this would help. Thanks for watching.